Welcome to Wealth Builders with your host, Anthony Congemi, brought to you by Crescent City Retirement Group, the show that's all about helping you grow, protect, and secure your financial future. From Social Security maximization and strategic 401k and IRA planning to tips on life insurance, Medicare, and annuities, Anthony and the team at Crescent City Retirement Group have the tools you need to help set you up for a successful retirement. It's time to take control of your financial future. Now here's your host, the trusted voice in retirement planning, Anthony Congemi.
All right, welcome to another show of Wealth Builders. My name is Anthony Congemi. We want to thank you so much for tuning in to our show this morning. We have a very special guest we're going to be talking to. But before we get into our guest, I want to thank our co-host, as Tony has been on this show for the last 10 plus years. We really couldn't do the show without Tony. Tony, thank you so much for being here this morning.
Oh, Anthony, I wouldn't miss it, especially since our guest. I'm honored to have Jim Gaffigan on the show today. Oh, wait, no. Is that Jim Gaffigan?
Wait, let me make it a little better. There we go. I even have the Jim Gaffigan glass.
Okay, there you go.
Hey, you've heard that before, that you look a little... Once or twice. No, it's Kevin Willis. Tell us about Kevin, Anthony.
Well, Kevin is a CPA, and as we talked about earlier on the show, he's really blessed us this morning because they're so busy right now. But we had our tax topics this month on our show, and we, asked and almost, begged Kevin to come on the show this morning. He's very, his firm's very busy right now, as you could imagine, but we're so thankful to have Kevin on the show this morning. And so, Kevin, why don't you tell us a little bit about your background, your firm, for our listeners?
Definitely. Well, I'm a New Orleans native. I've been practicing for a little over 21 years. I've worked with the 12th largest accounting firm in the country. I do tax. I do a good bit of everything. I'm an expert witness in several legal areas. I do IRS audit representation, financial statement audits, reviews and comps, different things like that. But what I'd like to do is I like to use this tax information and work with a team environment of either an individual or a business's board of directors, if you will, or their team, to help figure out the best course of action to follow for these people. I also serve as the chairman of the Federal Taxation Committee for the Louisiana Society of CPAs right now.
Excellent. Yeah, well, I tell you, Kevin, we know you're a busy man, and we're so honored to have you here, sir. And, our listeners, we talk a lot about, how taxes and tax planning really infiltrates all aspects of a retirement plan. We're big on 5 key elements to retirement planning: estate and legacy planning, healthcare, investments, of course, income planning. And we like to say that taxes really infiltrate all aspects of that. And so that's why, I say we're just so thankful that you're here. And we have some questions, but before we get into our questions, in general, Kevin, your business clients, we have a lot of listeners out here that are in business for themselves. And, certainly, when you're working for a big company, a lot of the benefits are already kind of laid out for you, and with with businesses, especially smaller businesses, a lot of times there's tax, things that they can be doing to take advantage of different types of retirement accounts to help offset some of their taxable income, and they're just not aware of it. I mean, is that a fair statement?
That's absolutely a fair statement. I think it's a little, so, all right. In my experience, the average, and we're talking, businesses anywhere from $200,000 in revenue to $50 million in revenue, right? I mean, it could be anybody, anywhere in between, where you would think as a just kind of a person on the street, you would think, wow, they really got their stuff together. Well, they may know how to do what they do very well, but they do not know the things they don't know. I hope that makes sense, right?
Yeah.
So you don't know what you don't know. I mean, that's true.
So, and if you don't have a team of advisors, and if you don't have somebody to talk to, then they are missing out on different things, because, you know, especially here in New Orleans, and in the surrounding area, it's, hey, my brother did this, so I'm going to do this. Or my neighbor told me, oh, this is the best thing to do in the world, so I'm going to do that. But that's not necessarily the best thing that they can do. It's not even necessarily legal sometimes, but they do it anyway. So, you know, what we try to do is bring people in and talk to them, and bring people, Anthony, like yourself, and let you guys let's sit down, and we know their business, right? We know the financial part of their business. You know what's available to them, and you and I can have a conversation in terms of what's in their best interest, from what we know from the client, from working with them, from what their goals are, from what do they want to do, when do they want to retire, how do they want to pass things on. You know, we were talking about, you had said things, you know, about
like a estate and legacy planning.
Estate and legacy planning. Mm-hmm. Like, you know, this is multi-generational things.
Correct.
So this is, how do we want to pass this off? How do we want to write this up? What's the best way to do it? We were working with just last year, we saved a client about $633,000 because we looked at their succession planning. We look at their planning, and it was written horribly. So just because we took a look at it before they pulled the trigger on it, we were able to go back and change attorneys and get that written up in a way that it was a non-taxable event. So it's just knowing, it's just having people understand that you need somebody on your side, you need a team.
Right.
And, you know, we do tax returns, but the tax returns aren't our product. It's the advice that's the product. It's working to better the client and actually, you know, what do they want to do? Because if not, they'll just go off and they'll work 60 hours a week, 80 hours a week, and keep making money, or not keep making money. You know, it's really kind of one of those things. But.
Right. Yeah, absolutely. And, you know, you mentioned team a couple of times, you know, and a lot of times the right hand just doesn't know what the left hand's doing.
Yep.
So you could have an attorney doing the estate planning. You could have a CPA handling taxes. You could have an investment person handling investments, insurance folks doing insurance. But if that team isn't collaborating, you know, let's face it, you get a better result when the people that you have in your corner are all communicating and we all, you know, we're all pushing in the same direction.
Absolutely.
You know, so and that really is honestly what you know, what we feel so strongly, and one of the reasons this show exists is because we want industry experts. I mean, the things that that you know about tax planning and building tax plans for folks, and as you say, you know, you can do a return, but tax preparation and tax planning are really two different things.
Yep.
You know, but then if you don't have the investment folks that are doing their job, and you don't have the attorney with the proper documents, right, then it can go, it goes south in a hurry.
It goes wonky really quick.
You know, so very good, Kevin. So let me ask you, you know, I have a handful of questions here that that we put together, and I'd like to ask you, for starters, you know, question number one, what is the difference between, let's say, a traditional retirement account and a Roth?
So the very simple part of it is one's deductible now and one's not deductible now. Now, that's the simple. The when you get into it a little bit, the traditional is deductible in the year that you make it, in the year that you make it. and it grows tax free. So, but when you take it out, when I believe we're going to talk about required minimum distributions, all that kind of stuff. When you start to take it out, it's all taxable. With a Roth IRA, you're making a Roth IRA contribution with after-tax dollars. So it's not deductible in the year that you make it. It grows tax-free, but then when you take it out, you're good. It's not like the traditional. Now, the downside of the Roth is that there's limits, there's income limits to how much you can make in order to put money in there. But that's really it. And most people, unless you're using the traditional, or what we see, right? Unless you're using the traditional as a very specific part of some kind of a tax planning objective or some kind of your tax plan, most people are using the Roths because it's just such a no-brainer.
Mm-hmm. Such a powerful tool, huh? Yeah, I read somewhere it was the name of the book was The Tax Time Bomb, written by Ed Slott. Yeah. And he said in the book, and he used this analogy of a farmer and basically, farming. And he basically said, would you rather pay taxes on the seed or the harvest?
There you go.
And I thought that was a really good analogy. As you say, when you use a traditional retirement account or a traditional IRA, you're saving money on the taxes on the initial deposits that you put in, but then all that money grows tax deferred, and it ultimately comes out tax free. Not only what you put in, but all the growth. Which would be the harvest, let's say. So yeah, very good. So in your mind then, and the way things are with taxes and, where taxes are even headed, which really begs the next question, which I don't know if it's on my list here, but I just, where do you think it's all headed, Kevin, with tax? I mean, my goodness, we're hearing so much about, tax reform and Social Security taxes and
get out your crystal ball.
A simple flat tax. I mean, come on now, you're in the know.
I can excuse myself. I have to go down to the car and get the crystal ball. Well, the good thing is, so I go to a tax conference in Washington, D.C. every year, and it's in November. And last November, of course, this was a big, huge part of what we talked about in every single meeting that I attended. And the short of it is we don't know. Okay, now that's the easy. Hey, I don't want to put myself on record for anything answer. Oh, and by the way, any of my opinions, I have gotten in trouble for this before. Any of my opinions are my opinions, not the opinions of the State Society of Louisiana.
Sure.
So I'm not speaking for all of the CPAs in the state, but so what we're waiting for and what I'm hearing is that in the third quarter, they're going to take up some kind of tax legislation. All right. That's kind of what we see setting up. We see people starting to talk about tax issues and things along those lines. The people that I talk to in DC are having an issue where things change on the fly. Like some of them, get their information from Fox News, just like a lot of people do. Half the population probably does. So it's a very difficult thing. But now, so what I think is going to happen is I think they're going to come in, with there's various things for business owners, for depreciation. There's some things that you use that have been phasing out. I think they're going to put those back in and make it retroactive to January 1st. I think whatever they do, they're going to make retroactive to January 1st. And I think, there's a lot of talk. There's so much talk. We have so many clients that have told us just file extensions for them because they don't think there's going to be an income tax come October 15th. And it's like, no, we still have to file a tax return. And if that is the case, that's fine. We'll deal with that when it comes. But let's stay the course. Let's stay where we are. Let's do everything the same thing that we're doing now, let's keep doing, because nothing's done until it's done.
Right.
So now what do I think has a good chance of being passed? I would like to see, the tax on Social Security, even though you're only taxed up to 80% of what you make on your Social Security earning, your benefits. I think that's got a decent chance from what I hear of not being taxed. They talked about not taxing tips, not taxing overtime, things along those. That's a turkey shoot. It doesn't just, there's no, I don't know if that's going to work or not. Right.
On the Social Security, I mean, correct me if I'm wrong, but we're all putting into Social Security with after tax money, right. Correct?
That's right.
So I guess the argument, it makes sense, is this money was already taxed.
Yeah, I mean that's the reason everybody's so up in arms about the that it's even taxed at all, and any portion of it. And what we see now is people now are retiring and making more than what they were making when they worked, and it's or the same. And when all of this was set up, it was set up for even the traditional IRAs. It was set up for you to be taxed at it was an assumption in the 80s, 90s, 70s, 80s, 90s that you were gonna come out of working and you were going to go into retirement making less than you made while you worked. So that income would have been taxable. The reason you were putting that money into a traditional IRA is you were saving money at a higher tax bracket, at a tax rate, because you were working and making the majority of your money. And then when you pulled it out, you'd be taking that money out at a lower tax rate. And that's just not happening now. People are people have made a lot of money over the last several when you look over a 30, 40, 50 year period, is different than when you looked over since what happened in 20 with the pandemic, what happened in 2008, what happened in the relatively, I would say, near the last several years, the last couple of decades. But there are people who have built a significant amount of wealth, and that's just not what's working. That's not the way it's happening. So people are trying to maybe transition some of that traditional IRA money in years that, these years that are bad, maybe trying to transition some of those traditional IRA dollars into Roth IRA dollars or some things along those lines. Anthony, I'm sure you've seen that, and that, I think it's a sound advice if you do hit a low year, which some people will. The jury's still out on this year. It's still, we're still only in April, but it may be a good year for people to move some money into a Roth IRA this year. It may not. We'll have to see how that works. But that's does that answer your question? That's really.
Yeah, absolutely. I mean, so you're thinking that, with this Tax Cuts and Jobs Act, I mean, we know that tax rates have been favorable, let's say,
at historic lows, right? I mean,
yeah, they are. Yes, absolutely.
So, I mean, getting to your point of the Roths and everything, and then possibly moving some of those assets over to the Roth, let's say, and even, as we speak, the market is having some pullback, obviously, with the tariffs and this trade situation that's happening amongst these countries. And so with all that said, being in a historically low tax environment and then maybe having assets that have pulled back, might be high time to look at some of those Roth conversions.
Yeah, especially with the stock market, especially if we're looking at well, more about that. I'm not going to talk about to this, but if I would, in my mind, it's if you have some dogs in your portfolio that now are not going to come back, now's the time to ditch those. But that's your purpose.
To get that, get them out. Absolutely. All right. So tell us, tell us about required minimum distributions. We have people that'll say, well, if I don't need the money, I don't need the money. So why not just defer on my retirement accounts? I don't need to pull it out. Why pay the taxes?
Yeah. I mean, the reason to take the required minimum distribution, honestly, is because Congress tells you have to take the required minimum distribution. There's not a lot of people who want to take the required minimum distribution that we find out of our clients. We get that question a lot every single year when the investment houses send out the RMD questionnaire, or do you want withholding, or do you want that kind of stuff? We always get questions like, I don't want to take it. I don't want to take it this year. Because again, it's like we're talking, people are in a much better position now than they were when they were working. It's like, no, I'd rather leave this for my kids. I'd rather leave this. Well, and that's why Congress put the required minimum distribution in there, so you couldn't leave the whole thing. You had to put some of that into the economy. You had to put some cash flow. You had to loosen some of that up, and you couldn't transfer 100% of it forward to your next generation. But it's I mean it's such a small amount too, so it's such that you're required to distribute, to take. There's not many practitioners who are let me put it this way: the practitioners I talk with, there's not really one of us that's really in favor of it. So.
In favor. Yeah. Well, and we run into, in our own practice, we'll run into people, let's say even in their early to mid 60s, and they'll, when we run these RMD calculations that push, show what's going to have to come out at 72 or 73, depending on when their RMD is required. What we're hoping to do is have a more even distribution on those qualified assets over time, and maintain the tax bracket we're in. And then when everything does default to RMD, you don't see this real large spike in the income, more of a strategic distribution, a tax smart, if you will, distribution strategy, whether they take the money themselves or do those Roth conversions that are not subject to RMD, then just defer, kind of put your head in the sand, then all of a sudden let it blow up on you at 72 or 73.
Right.
And unfortunately, that's what most people do. They just wait, and then
and then all of a sudden, the tax, and we don't know what taxes are gonna, rates are gonna look like in the future. So, and there's a penalty, isn't there, if you don't?
A penalty if you don't take the full required minimum distribution. Yeah.
Mm-hmm.
On top of the taxes you'll have to pay on the money you pulled out, you'll have to pay that 10% penalty. Yeah, that's not good. That's another reason why you guys are talking about having a tax-free bucket of money in retirement, right?
Yeah, definitely.
Absolutely. And so, very good. And so question number 3 on taxes and retirement, this PDF, tax deferred versus taxable investment accounts. What do we need to know there, Kevin?
So we're, the first thing that comes to mind is if you're in your 20s, 30s, 40s, max out your 401k. Just max it out. Max out anything that's going to get matched, and your employer is going to match for you, whether it's a 401k or a SEP or a simple or something like that. We always just look, if you've got the cash flow, max it out. Especially if you're going to be, if your employer is going to give you free money to match that, that's really
first step, huh?
The first step.
Tony, what do you think about this tax planning thing?
Well, I think it's important, obviously, especially for people who are planning for retirement or already in retirement. You don't want to be left with what you refer to, and Ed Slott mentioned in his book, a ticking tax time bomb. You want to make sure you're working with tax professionals like Kevin Willis with us today. A great talk, but we're out of time. Anthony, before we go, let our listeners know how they can get a hold of you. If they have questions for you or Anthony, or you or Kevin, I should say, what can they do?
Absolutely. So first, we just want to thank you all so much for joining us this morning. We especially want to thank Kevin for coming out his busy schedule, before April 15th.
Well, thank you for the opportunity. I appreciate it.
Well, thank you, sir. And we appreciate having you. So listeners, CrescentCityRetirement.com. You just go to CrescentCityRetirement.com or pick up the phone and call us at area code 504-828-2171. If you have any questions at all, any tax questions, especially this month, we are really focused on tax planning and tax questions. We can get you in touch with Kevin. We know through many, many years of investment planning and retirement planning that taxes literally infiltrate every aspect of a person's retirement plan, and not having that tax piece shored up can really create more expenses and taxes and issues down the road, when we could have just had a plan coming in and going in up front with some good tax planning. And so we appreciate Kevin being on the show. And again, if you would like to ask any questions at all, if you'd like to get the piece on taxes and retirement, just simply call us at 504-858-9427 or go to CrescentCityRetirement.com.
All right. Sounds great. Thank you, Anthony. Thank you, Kevin. And that does it for today's episode of Wealth Builders with our host, Anthony Congemi.
Thank you for listening to Wealth Builders. Don't pay too much for taxes or retire without a sound income plan. For more information, please contact Anthony Congemi at Crescent City Retirement Group by calling 504-828-2171 or visiting them online at CrescentCityRetirement.com.
Fee-based financial planning and investment advisory services are offered by Crescent City Retirement Group, LLC, a registered investment advisor in the state of Louisiana. Insurance products and services are offered through Crescent City Insurance Group, LLC. Crescent City Retirement Group, LLC, and Crescent City Insurance Group, LLC are affiliated companies.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.